In finance, safety isn't free, but not every fee buys real safety. Let's see which ones are worth it and which to skip.
Global trade moves billions every day, yet behind every contract lies a question. Can I really trust the other side to pay or deliver? That's where letters of credit, L/C, and standby letters of credit, SBLC, come in, tools designed to bridge trust across borders. But here's the truth. Many companies pay for protection they don't need, wasting thousands in unnecessary fees. Today, we'll decode how to use L/CS strategically, where every dollar of fee actually reduces risk, and where it simply enriches the bank.
Think of letter of credit as a bridge, not a wall. It connects trust between buyer and seller.
A letter of credit is a commitment by a bank to pay a seller once certain documents prove that the seller fulfilled their part of a deal. An SBLC, or standby letter of credit, works more like an insurance policy. Payment happens only if the buyer fails to perform. These instruments are independent of the main contract, meaning even if there's a dispute in delivery or quality, the bank must still pay if documents comply. They're essential in international trade construction or EPC contracts, project finance, and tenders. But the big question is, are they always worth the cost?
Smart finance isn't about paying less, it's about paying right.
Banks charge L/C fees like insurance premiums. But just like insurance, you don't insure what you can afford to lose, and you don't pay to cover a risk that doesn't exist. Letters of credit and standby L/CS are powerful tools, but not every fee is worth paying. When dealing with new or unknown international clients, fees are worthwhile. The bank shifts credit risk off your shoulders. But with well-known, financially strong clients, those same fees are often excessive. In emerging markets or unstable regions, L/CS provide real protection. Yet in developed, stable countries, the fees may simply enrich the bank without reducing risk. For high-value or complex tenders, protection is essential. But for routine, low-risk trades, the cost outweighs the benefit. The takeaway? Use L/CS strategically. Pay fees only when they truly reduce risk, not when they just reduce your margin. This graph visualizes the sweet spot. Fees are valuable when they offset significant uncertainty. Paying confirmation fees in low-risk contexts doesn't increase safety, it only increases cost.
Every fee must tell a story. What risk did it actually remove?
Letters of credit costs are often misunderstood. Let's break down what you're really paying for. First, the issuance commission, usually 0.25 to 1%, paid to the issuing bank for creating and maintaining the L/C. Next, the confirmation fee, 0.25 to 2%, paid to a confirming bank. This adds a second guarantee, especially useful in cross-border deals. Then comes the discrepancy fee, a fixed charge to the seller whenever documents don't comply with the terms. You'll also see amendment or advising fees, variable admin charges whenever terms are modified or advised. Finally, the discount fee based on tenor, applied when sellers want early payment, similar to factoring costs. The takeaway? Every fee has a purpose, but not every fee reduces risk. Smart CFOs know which charges protect liquidity and which simply enrich the bank. The confirmation fee is like a comfort fee. It makes sense only if it truly substitutes for weak credit or political stability. If you pay for confirmation from a world-class bank in a top-rated country, you're buying comfort, not safety.
Not every risk needs insurance, some need process.
An L/C's strength lies in how it transfers risk, but knowing which risk it addresses helps you avoid redundant safety layers. Letters of credit fees only make sense when they actually reduce risk. Let's break it down. Payment default. The bank guarantees payment if the buyer fails. Fees are worthwhile when buyer risk is greater than bank risk. Country or political risk. Adding confirmation creates a shield against political or currency instability. Pay the fee when instability is visible, not when markets are stable. Document or performance risk. Strict documentation ensures compliance in complex contracts. Fees are justified when tenders are high value or performance terms are intricate. The takeaway? L/C costs are strategic. Pay them only when they truly protect liquidity, not when they simply cut into margin. This flow shows that safety doesn't come from paying more banks. It comes from choosing the right layer of protection.
You can pay for comfort, but true confidence comes from understanding.
A common mistake, companies automatically request confirmed L/CS, even when unnecessary. Let's visualize why that's wasteful. The visual makes one truth obvious. Confirmation follows risk, not geography or habit. Asterisk, asterisk. Before paying any extra, ask, has the risk really changed or just the contract paper?
When a bank offers LC confirmation, your first question should be, why?
If L/C fees outweigh the protection, you have smarter options. Trade credit insurance, often cheaper, ideal for repeat clients. Trust receipt financing, T/R, converts L/C payments into short-term post-shipment loans. Bank guarantees, simpler than full L/CS for performance-based contracts. This helps management visualize trade-offs. It's not about cheapest, but right-sized protection.
Finance strategy isn't one size fits all. It must match the level of risk.
Every tender or project is different, and so should your letter of credit design. Scenario 1. Stable country with a strong client. Risk is low. In this case, an unconfirmed L/C or even an open account with insurance is usually enough. Scenario 2. Medium risk country with an average client. Risk is moderate. Here, a confirmed L/C with simple terms provides balance between cost and protection. Scenario 3. High-risk country with a new client. Risk is high. The safest option is a confirmed, transferable L/C routed through two banks, adding layers of security. The takeaway? Match your L/C structure to the risk profile. Don't overpay for protection you don't need, but don't underprotect when the stakes are high. The pyramid shows how to escalate structure based on real risk, not fear. The higher the uncertainty, the more structured the bank involvement should be.
You don't buy safety by paying more. You earn it by knowing what you're paying for.
Let's summarize. L/CS transfer trust, but trust has a price. Pay only when fees reduce your risk, not just the bank's discomfort. A well-structured L/C improves liquidity, minimizes disputes, and increases payment certainty. Always ask, does this fee change my risk or just make me feel safer? If you found this eye-opening, subscribe and join me, Thanya, where we turn financial complexity into clarity you can act on. Thank you for watching. To explore more, from tender finance to trade risk optimization, check the links below for full articles. Until next time, make your finance strategy smarter, not costlier.
See all differently? Subscribe and join me, Tanya, where finance becomes clarity you can act on.